YouTubers, welcome to the Independent Investor for March the 19th, Thursday. Like I said, we've basically, in my last video, we're in a bear market now, and the markets have continued to decrease. Today we're seeing a rally on the markets, which I think will be short-lived, basically from the governments getting together and deciding what fiscal measures are going to take outside of what the Federal Reserve Bank has done. We've heard in the States individuals getting $1,000 check, extending EI, and also there's been talk of the US actually buying shares into companies that they're having a real hard time dealing with the coronavirus, such as airlines. So that's supporting the market, but I'm still bearish. I still think that we've got a ways to go down yet. This is unprecedented. A lot of people comparing this back to World War II, that type of thing, or even the crash in 1929. We've never shut down whole economies before, like we've seen in Italy, good parts of the world now. So one metric I did, just going by general recessions, and this market did get quite overextended because of the low interest rates that I've talked about in previous videos. But just in a common recession, it's quite normal for earnings to drop 30%, and if you give a price to earnings ratio of about 15 on those earnings, right now earnings for last year are about 130, so if you decrease that by 30%, you get roughly $91 in earnings. This is for the S&P 500. You multiply that by 15 and you get roughly 1365. So showing that on the chart here, we can see right now we're at 2400, and that would still be another drop of over 1,000 points, and that would get a lot of the valuations back into line, which they have been over decades. It's kind of reverting back to the mean. The markets kind of overshoot on the upside and overshoot on the downside, so there's a chance we could go below that. But we might not get quite that low, just because interest rates are still quite low, and basically everything is determined by future cash flows, and if your denominator number interest rate or the risk-free rate is lower, then you do get a higher asset value. So anyways, I still think there's pretty good possibility that we see, you know, another 500 to 1,000 points on the downside. And also, we don't know how good the earnings are. A lot of companies have been announcing earnings before income tax, depreciation, focusing on which is not a real number, and they've probably got more aggressive with if they're willing to report their earnings before income tax, depreciation, and amortization, and emphasize that number, and instead of true GAAP accounting, then even their GAAP accounting, they're probably being a little bit more aggressive, and typically all these things come out during a recession. So the earnings that we have now might actually be lower if they were treated using more conservative accounting measures, so that's another bit of a risk. The VIX, which I've talked about before, is back to all-time highs that back in 2009. Another reason to kind of stay out of the market. We can see here we spiked all the way up to 85, having a little bit of a rally today, like I mentioned, so it came down to 75. But before I did a lot of buying, I'd want to see this trend down into, you know, maybe below 40, then below 35, 30. Good solid trend down, seeing the risk is removing from the market. And I don't see that really happening there's still the coronavirus, cases are still going up. We haven't really, as I say, flattened the curve anywhere in North America. So there's still, and even most of the governments are still have a large amount of debt and deficits. So now they're going to have to go deeper into debt, and I'm not sure how that plays out. The American dollar has strengthened quite a bit. It's still seen as a safe haven, and it's actually performed better than gold and silver over the last week or so. Silver, for some reason, has really been knocked down pretty hard, and gold was still on an upward trend, but the US dollar seems to be as a bit of a safe haven right now. That being said, I still did a little bit of buying, and I mentioned these stocks previously. I mentioned them in a few videos. The renewable energy companies and electric utility companies. One of the basic things we're going to need is kind of electricity, no matter what, and these companies I did correct, and I decided to start to buy back into them. I bought RNW, which is Transalta Renewables. I'll put all the symbols in the comment sections. It's yielding now 8.92%, so that's an excellent yield. And NPI, which is, see what the yield is on that. So that is Northland Power, and that has paying a dividend of about 5%. Again, I just bought small portions of these, and I did buy Emera, which I will talk about later in the video, and that's basically mostly electrical generation company, but also gas line distribution. And so one thing I like about these green energy companies is they have pretty long contracts. Most of them are power purchase agreements for up to 20 years. So their cash flows, we know, are going to be there, and they'll be able to continue to pay their dividends out. 96% of the expected power for 2020 is contracted out, and the average power purchase agreement for all these stocks is like I say, 11.7 years, with some being up to 20 years. So based on the 2020 forecast, this is from TD, the payout ratios from effective funds from operation is about 73%, so that's pretty conservative. So even with what's all going on, even if the payout ratio increases a little bit higher, there's still that quite wide margin for error. So I think it's a safe place to try to put some money and get some dividend yield until this coronavirus plays out, which is probably going to be at least a few more months before we even probably see a peak in the numbers. And then we still got to slowly get people back to work, open up businesses, and see what unemployment's going to be like, that type of thing. So another thing I mentioned was, another thing too, is these, this came from Carbon Tracker, think tank in the States, and it's saying that more than 60% of the global coal power plants are generating electricity at a higher cost than building a new renewable energy facility. So now wind power, solar power is actually below the cost of coal generation. So we're going to see more growth in this area as coal plants get shut down and transfer over to green power, predominantly solar and wind. So that's a nice tailwind for these types of companies. Another thing, again, I keep talking about China as kind of the first sign for what can happen to the economy, and we've got some data just came out outside of people that looked at air pollution and traffic, but this is more hard economic data. And the country pretty much came to a halt last month with industrial production dropping 13.5%, which is a bigger dip than the 2009 financial crisis. And of the 41 major industrial sectors, 39 contracted, with oil and gas being, oil and tobacco being the only two exceptions. And now oil's probably down because of the $20 increase in crude oil. I did also buy TRP, which I've had before, Trans-Canada Pipeline. It's been a phenomenal stock over the last 20 years. I've talked about in past videos. Again, I just bought a small amount, but I am a little bit concerned about gas pipelines because, as I'll talk about shortly, bond yields for corporate debt are starting to increase quite a bit. And a lot of these fracking companies might not be able to refinance, and they might go out of business because they're going to have problems